Good morning, all. Morning. Sorry about that. Had a few pages in the wrong place. Hope everyone's all right. You're right, Kay?
Yeah, good morning, Ryan. Yeah, all good, man.
Good. Hope everyone is doing well in the room. Good morning to you all. Right, bit of a fairly quietish morning in terms of news and bits and pieces like that. Just some quick headlines to run through. A few bits and pieces. RBA's low was out early this morning, pretty much putting a block on a 75 pip hike expectations at the July meeting. More likely to be 50. Says it could be anything between 25 and 50 basis point hike in July. So just bringing down a touch of the expectations that might have been running ahead of themselves. Into Germany, big industrial group, the BDI, cut German GDP for 2022 to 1.5%. This was up at 3.5% before the Ukraine stuff kicked off. We've seen various growth forecasts cut through the Eurozone and elsewhere. Going to be a theme we're going to be seeing moving forward as rate hikes kick in and as we see what economies happen and how they may stutter. A lot of ECB waffle out as well. The floodgates are open on all the central banks now. We're past the blackout periods. Pretty much we had Casimir, Ren, a couple of others, Lagarde yesterday. The main waffle today is that some see the end of negative rates in September. People like Casimir see a 50 pip hike as highly probable in September. Lagarde yesterday in her testimony to EU Parliament largely tried to maybe keep expectations grounded, let's say that. She's still expecting a 25 pip hike in July and September. Usual caveats still there as they were in the statement that they could do more if needed or change policy as and when they need. Bank of England as well, just a little bit of a creeping in and talking about FX there, about the pound and its impact on inflation. Obviously, being a big energy importer as the UK is, a lot of those energy markets are priced in dollars. Cable going the wrong way is obviously negative to that in terms of its costs more to import. So even as energy is rising and the pound's falling, it's a double whammy for the UK. So both Bank of England's Mann and Peel commenting on the pound effect. There's talk that there's insinuation that they might need to go bigger on hikes to combat that impact. Now it's a dangerous road to take in my opinion, because you try and use the currency to fight inflation or as a basis for monetary policy, it's you pretty much on a hiding to nothing. If you're talking flow terms, obviously the dollar is the bigger currency. If you're trying to affect cable, yes, rate hikes can obviously bring in the divergence trade, which obviously impacts the FX rate. But with the Fed going as full tilt as they are, the Bank of England is already behind them, or is going to be further behind them just for scale of rate increases. So either the Bank of England's got to play catch up, but even so, it doesn't mean that the cable is going to naturally jump up 300, 400, 500, 600 points and lessen the impact from inflation, because you still got to match off which economy is likely to be the stronger. And it's at the moment, as we've been saying, the US is looking the strongest economy. It's looking more likely to wear rate hikes than someone like the UK. So that alone will keep some differential in the currency. So I think it's a bad line that the Bank of England may be taking if they're going to start hiking just, I wouldn't say just on the currency, but with a big view of the currency in mind. They're likely to come unstuck on that theme. But that's something to keep an eye on, see if they do make it a bigger part of monetary policy decisions. Perhaps we'll hear from some of the others, MPC members, their thoughts on it as well, and we'll get a better picture on that. So pretty much not really anything else on the headline front coming up. Kay, I don't know if you heard anything. We had a few loose bits and pieces from Japan's Kishida, PM Kishida, about FX and the Bank of Japan. No need to change policy right now. Nothing
No, and
Nothing wrong.
that's the issue with Japan, right? You can say that your currency is should not be weakening more, but if your flows are negative and if your bank and if your central bank is buying having 50 or more percent of the whole JGB market in the portfolio and keeping the foot on the yields, what do you expect, right? We had the trade balance last week was extremely negative still for the yen. So I don't see how, without moves of moving the Bank of Japan or a global hard recession, I don't see how yen can strengthen for more than a couple of sessions, or yeah. And we still don't know how if they would intervene, how they would be looking at those interventions. They can just go and sit on top, so it's going to have like an immediate effect of sending dollar yen 100 points lower, but then it's going to come back. It's going to come back straight to the level. And as you were saying, the comments about the Bank of England are a bit the same, not the same way, because the central bank is hiking, but if your natural flows are negative, you can talk about the currency whatever you like. How long is the currency going to benefit from just talking and saying like, oh, the sterling is too weak? Yeah, but if you are behind the rest, and if your economy is not doing great compared to the rest, I mean, your currency will see natural negative flows, and
Yeah,
you can't direct the currency with talk alone. Right?
exactly.
Central banks should know that, right?
Yeah, because when investors look at where they want to put their money, they put their money in a strong economy or growing economy.
Yeah, if your
The
trade
UK.
balance or current account is not looking great, the natural flow is outflow,
Yeah,
and you
yeah.
can't.
That's why it's a potential dangerous road to take, in my opinion.
Yeah,
And it's one that if they do jawbone the currency up, or if they do say that's why they're hiking and the pound rises, that's going to be a bit tempting to fade, in my opinion.
oh yeah, definitely.
So that's something to keep an eye on for the quid moving forward. Anyway, just a quick look at what's coming up today. A bit light on the data still. We had obviously Lagarde out yesterday. We've got Canada retail sales coming out. Might be a little bit of a market mover there. Definitely one to keep an eye on for for CAD anyway. US existing home sales expected to come in a bit softer again, 5.39 from 5.61 million last month. In April, that was down from 5.75 the month before. So again, we're looking at this data to see how hard the housing market in the US is going to get crunched. This is the second round of the main housing data points. Is a bit lagging, so we've still got to see some pass through there, but that's on the calendar today. Pretty much it. Some speakers coming up. What we have got, just to flag it up, is tomorrow we have Powell testifying, the Humphrey Hawkins, which is the testifying on the monetary policy report, semi-annual report to the houses of the US. He does it in two hits. There's one tomorrow, and then it's usually a repeat on Thursday. I think it's a bit earlier tomorrow. It's 13:30 GMT, which is 14:30 BST. Usually it's a half hour later. Now what we do with this one is we often get the text of the statement usually about an hour before, sometime about an hour before his actual appearance, and then he gets questioned for God knows how many hours. I remember when we used to have to sit through Yellen doing it, and God, that was boring. The only game I used to play was counting how many times he said so. But Powell's a bit more chipper, but it could be unless he's got any surprises in there, which again, like Lagarde yesterday, there shouldn't really be any surprises in. We've got a pretty good idea of what the Fed want to do after the FOMC, so it's probably going to be pretty much a repeat of that. But there is a slight risk that he says something that we don't know, so that's something to keep an eye on. tomorrow. So that's all the headlines pretty much run down now. So we'll jump straight into the price action. Seeing a little bit of a, I call it mild risk on move. We're seeing the dollar sold really across the board. If you look at some of the pairs, you know, we can see euro dollar here just having a little move up. Cables in the same boat. Dollar CAD, that's had a little sell off. Euro crosses pushing a bit higher. Pound crosses or yen crosses pushing higher. So it's looking a little bit risk on-y, but I don't know if there's just there's definitely nothing's changed in the world to warrant a big risk on move. So it could be that we're just seeing a bit of leg stretching, as we call it, where the market's just got no reason to go down anymore. So it's going to go up for a bit. Look for the ranges in some of these moves, because, you know, if we start hitting some of the key levels, you know, having another look at, you know, 106 in euro dollar, having a look up towards that 106.35 S&R point up there. You know, those are the sort of levels, if we are going to be seeing something in today's moves, it's those sort of levels that are going to need to break to push on. Failing that, we potentially could be just sitting in some of the well-worn ranges. Dollar yen is looking like it's stuck in the middle of, as I say, the cross currents. So where we're seeing other yen pairs rising, but the dollar offered elsewhere, dollar yen seems to be a bit stuck in the middle. I was watching this earlier just to see how we got on around these highs, and we got a pretty good slap into that, you know, edging up towards the 50 area. I know Kay's got the sniper rifle out for longs into 135. I was looking at maybe having a little short up here, potentially with a stop reverse or running a buy stop above, just playing the levels, nothing huge. But it did get a fairly decent slap into 50 up there. So, you know, beginning to wonder if there's a bit of exporter interest up there, and a few people parking the bus. So a level to keep an eye on, probably 135 today, up into that 135.60 highs. You got any thoughts on this one?
Yeah,
Okay.
as you say, it's like a cross yen move this morning. I've chosen the wrong horse because I saw the dollar rates higher this morning, so I actually bought a few dollars. I bought dollar yen. I also actually went a bit short euro dollar, where I took 25 points loss on this morning. Was a tad surprised after what happened to Macron and the German or the whatever European gas situation still lingering on. But I think it's just like people probably a bit short euros overall, a bit short in risk, and then this move up in the equities together with the yields have put some upward pressure, especially on the cross yen. And took euro dollar and sterling higher with it. All the dollars are weaker actually, especially EM and dollar Canada as well. Yeah, on the dollar yen, we had this 134 or 40.60-ish zone from where we started, went up to 135.30, back down to 134.60. Looks like there's a few decent bids around there. And let's see if we can break above the prior highs. Yeah, 135.5. It could be that there are a couple of submarines up there, like the Japanese mega banks, maybe instructed to offer a few dollars, but we don't know. It's just it. I'd rather say it's probably exporters, because even though they have a negative trade balance, exporters are still trying to do business, and they will have a few offers here and there to repatriate their profits or their yen. Yeah, that's about it on the yen side. On the euro dollar, I also think 106, then 106.30, and that's where we are going to really get the real measure of is the euro stronger, or are we just algo plug-in, and if risk comes back down, euro dollar comes back down, and the dollar goes back up. We'll see. I'm really, the jury is out on there. we're in ranges. We're in ranges on the cable. I think we've seen the range 121.5-ish, 124 on that one, and it has to go above 124 and then or break back below 122 and then 121.5 to really start to pick sides again.
Yeah,
as you were saying, the central banks gave us a lot of information right now. We could be starting to see stronger ranges develop. We have seen the high volatility. We have seen moves. It could be that until the next round of central banks, or when data will really show us the direction, that we see more of a range trading environment. And I would say, barring perhaps the yen, because their Bank of Japan is really putting Japan on last in the whole central bank on central bank ladder. They are now bottom since SNB also started to hike. So yeah, I think the yen should remain a little more vulnerable than the rest.
Yeah, no, I agree with that. And I think we mentioned it, last week on Friday and coming into this week. We've had all these big events. The market has made the bulk of its moves now. You can't think that the dollar's going to rip higher on the Fed, because it hasn't now. So what's it going to take to get the dollar ripping higher? It's going to be things like good data. But even then, we know where the Fed are set. So all the expectation or the majority of expectations for the Fed and the pricing for the Fed is all done now. So it's going to be the data. Does the data mean the Fed are right, or does it mean the Fed are wrong? And that's what's going to guide the moves. And as Kay says, we get these ranges, we get the big levels setting up. In something like euro dollar, if you're looking at it from the dollar side, are we going to start getting weaker data from the eurozone? It's already looking a bit iffy. So that's going to question, the ECB's path and hikes. Are they going to be forced to keep to a less hawkish tone? On the other side, if we start getting weaker US data, people are going to question the Fed's path as well. Now, that probably doesn't mean we're going to get huge moves, but if we've got these decent ranges set up, if we've got decent levels to trade, those are the ones that they're going to have to break. If data's strong for the US, but euro dollar can't break 105 on a test right over the data, well, there's your marker. It's letting the price action do its thing. We have got this range. We're looking at probably 104 with those little extensions down to the mid-low 103s, and the big levels up at 108. That's a 300-400 pip range to play in. That's a decent range. That gives you some room for the market to move around in. Something's going to have to happen for us to break those ranges. It's going to have to be something super good or hawkish from the ECB to bust the upside, or something super negative in the US and vice versa. So, Charles is asking there, what's the potential target, any target for euro dollar? I'm not in anything at the moment. I just wanted to get over the last week and see how things stand this week. But yeah, I'm going to be looking potentially to play the range. I'll try sort of maybe scalps, small trades into 105, maybe increase into bigger trades if we get down to that 104 area. Obviously taking into account whatever the reason we're being driven there. Same on the top side as well. Is 106.35 worth a potential break trade? Maybe. It could give us some room to the upside and a push up towards 108. If we get up to 108, my trade up there would be, to look at shorts, again, keeping them fairly tight, looking for a potential break, maybe to reverse into a long. But the problem with that is I've got another zone up there, as you can see, that 108.30 to 70 area. It's been a bit of a historical traffic point. Need to factor that in, what sort of margin can I possibly get? you know, in that zone up there. If I do a break trade above 108, say 108.15, 10.15, you know, and I'm expecting trouble to maybe appear 108.30, I've not really got a lot of room to get some pips in before we hit the next buffer zone. So we've got all these levels in the euro, and they're some of them are quite significant. You know, 109.20, 109.40. You know, they're fairly close together. So I'm having to fight how much margin I'm going to try and get in any sort of trades. But as usual, if I get into any trades, whether it's trading the ranges or trading the breaks, it's just about trying to lock in some profit as quick as possible and seeing where the market wants to go from there on in. Just having a look at a couple of the other markets there. Dollar CAD still looking like it's made a fairly decent double top there now in that 130.80 area. We're still in this 129 zone and holding it for now. Again, it could be significant. Are we going to play a range 131, 129? If we break out of it, you know, could we be heading back south? Again, I'm more likely to go with a break up than a break back down. I prefer to play the range in this. I was looking maybe for a move up closer to 131. You know, this is in an uptrend still, fairly long-term uptrend, but it is going a little bit sideways as well. That's coming in. Oil still not, you know, have we found a bottom here in oil? Been looking at this one, you know, obviously we had the breakdown, losing $7 odd or whatever it was, and the market's just saying, well, what now? We're managing to hold the lows, but we're finding we're banging ahead, you know, around about this 10, 110, 50, 80 area, call it. So a little bit of indecision here, you know, with this risk on mood, or seemingly risk on mood this morning. You know, you'd be thinking maybe this should be breaking higher. The fact that it's not could be a bit of an alarm bell ringing, a bit of a red flag that potentially we might be pushing back lower. But trade the levels. You know, we've got a confirmed low in place. We've got a confirmed top in place. If you're trading oil, you go with it. But, you know, dollar CAD, it seems detached today from the oil trade. You know, we had that big move lower. You'd expect dollar CAD to perhaps be a bit higher, but it's not. It's sitting pretty low to the lows of a few days. So we've got this correlation issue where some things are working, some things are not. And as a trader, I like to know. I'm not one for trading correlations. You know, if I look too much at oil to trade dollar CAD, I might as well trade oil. But it's just getting an idea what wind is blowing which way at any one time. Then you know what to look at. If a correlation is strong between the dollar and yields, fine, that gives you a bit of a bias of what to look for. You know, if yields drop and the dollar drops, well, you know what's moving. Same with dollar, CAD and oil. If it's moving on oil, you know that's the wind that's blowing at that particular time. If it's not, well, what is the driver then? And as Kay mentioned, looking at yields, again, a bit of sideways action. I really don't know what to do with yields here. Kay, is this probably, do you think the repricing of or settling down at the sort of neutral area, or where they think rates are going to peak out?
Yeah, I think so.
You know, looking at something like the 2-year 3.20, you know, that's not signaling expecting rates to be at 4% in a year or so's time.
No, well, the short end will reprice faster, right, than the long end now, because the longer end is looking at whether we are going to see a recession coming up, an interest rate hike driven recession possibly coming up. Although I think the first or even the next rate hikes, because they are at what now, 1.5%, something like that.
Yeah,
they can still weather a couple of rate hikes before needing to dramatically reprice. So the short end will be more volatile. But what was interesting is that we had a bit of support on the 10-year around 319, 320, and that seems to hold, which is also one of the reasons why dollar yen is holding, and one of the reasons why I decided to buy back a bit of dollar yen this morning. So there's going to be two things to play, which is the short end and then the long end. For now, there's a bit of a curve in there. They have re-steepened just a tad, although we are the jury is out between the short end, the belly, and the long end. It's a bit of a mess right now. But if the US could avert a real recession, we should see the yield curve steepen again. So that means that at one stage, the longer end is going to take off again. So we need to monitor that. But for the time being, and again, it's more like probably installing in a range, but we are holding certain levels, the 319, 320, give or take a BP or two, is holding, and on the 10s, and I find this quite positive for the dollar yen, and they are still looking to walk hand in hand pretty well in the end. Besides the odd cross-yen risk trading. So yeah, for me it's holding, and then the short end will react again when we will know when Fed is either going to pause or continue to press the accelerator. And then if they decide to go further because the data are holding up, if they decide to really go and sprint above neutral, which is their plan right now, then I think the short end will start to take off again as well, and we are going to probably move up anywhere between 3.5% and 4%, because that's where the possible end rate will be in this cycle. So for now, I think we are in a little bit of a pause, but we keep relatively high levels because they are still expected to continue.
Yeah, and just to explain to people who may not understand, when we talk about the curve and things like that, the in layman's terms, the curve, which is the difference in the various rates of maturities, from 2 years, 5 years, 10 years, 20, 30 years. The curve in the rates, it's two things. It tends to signal obviously the path of interest rates, but it's also inferred as to what that means for the economy. So if yields in the US show that they're high in the short term, so like we call the front end of the curve, like the 2 years, 5 years, if they're higher in there, but they're showing lower further out, it tends to mean that the rates are coming down. Now, what's the reason for rates coming down? It's potentially that there's problems in the economy. So the market, that's where the market likes to infer when you get inversions in the curve and things like that. It's the market saying, well, we're expecting problems further out. It's possible that there's a recession. There's a lot of people look at curves for whether there's going to be a recession or not, or a signal for a recession. It's not necessarily the case, because you can make that comparison between all the maturities. But just to give a little bit of an explanation on what the curve means when we talk about it, it just means where the market is thinking rates are going to settle, and then what that potentially means as to why they're going to settle at those levels. So yeah, just wanted to add that in, because some people might not know about that. I didn't know if you wanted to grab the charts, Kay, because a couple of questions, or one question on looking at Euro Swiss from NZ, and don't know if you're in pound Swiss, but Euro Swiss, definitely. I know you've been trading this one from the short side here. Do you want to grab the screen and run over that and maybe a couple of the metals? Hello.
Yeah, sorry, I was on mute. Let me grab the screen. Right, there we are. You can see my screen, yeah?
Yeah, got it, mate.
All right, Euro Swiss for MZ. Yeah, so since the S&P and even before, I've been trading this one on the short side. We have to respect the ranges for now, and the range to me is around 10. We've got this 101.30 here, and then we've got the 101, and which will in 100.90, which will be the key to see if we can have a test of parity. top side, there's a few interesting levels now, and I think the most interesting one is here 102.40.50 on the short term. If it goes through 102.5, 55, there might be a bit of short covering installing, but I am a core short, and I'm selling rallies, buying them back in any dips, and trying to defend the core short, which I probably will run well, probably until 103.5. But in the short term, I would monitor this 102.40.50, which could lead to a bit of short covering before reassessing. But my overall view is that still sooner or later we will have a retest of parity unless ECB goes all in on hikes and get their act together on the fragmentation tool. The other one, so let's have a quick look on the metals. Well, I've been showing this for days and days now. We're in the range. Watch this 28.35 support zone. Top side still 18.55, 57. We're in the range in gold, and I think it reflects what the more medium-term market is now doing, which is sit and watch for data. We have to know that metals will react to data as well, not only to inflation and yield. They will react to data, and the data will be important. If the US or the global data can remain in a reasonable territory, they will slow down versus 2021, early 2022, and the rebound of the economy. They will slow down, but what we have to monitor is to see if we get a real recession and where we are compared to 2019 data as well. So this one, silver, will, in my opinion, react the hardest to whatever will be either a recession or a holding up. If the data holds, this one, in my opinion, should be a buy on dip to fly later on. That is if the economy holds up pretty well with a high inflation. If in turn we're starting to see recession, since it's an industrial metal, I would be very, very careful. We could break through this 2090 area and have a look at 19s perhaps. But for the time being, in the range, and I'm not feeling too inclined to trade any of it. Interesting ones that we have seen, and which have actually, during the downturn of the equity markets, barring one or two spikes, have held pretty well, are those emerging market currencies, especially the ZAR and the MEX, which are the two that I really monitor. I had this 2080 marked in dollar MEX. Unfortunately, we haven't been really close, but we've put in a triple top here around 2070, and dollar MEX is all the way back down to 2015, 16 this morning. We could see the test here of this of 20. Possibly we have a couple of intermediate stations around 2010 and 2006. If my hunch is correct and that we are going to trade a bit more ranges, we should see a few bids coming around this 20 zone. This being said, don't forget those EMs now, they have been raising rates. They still will raise rates. We have got Bank of Mexico later this week. They will remain very high yielders. So, and that's, I think, what is driving them as well. So I'd rather sell relief rallies in dollar MEX or buy MEX against another currency, perhaps against the ultra low yielders, which euro and yen and perhaps Swiss still are. If you don't want to trade dollar MEX, but all in all, the EM currencies are holding up very well. They will have the same issue as silver, for instance, if we go really into deep recessions, because then traditionally EM is suffering. So watch for data there as well. The rand, similar thing. We tried in May back up there, and now we are unable to get back above 1610, 1618 zone. So if ever this goes back down sub 1587, we might be in for a test of 1560s. But I do think we are more in a range than in anything else right now. But I'm not an emerging market currency seller right now. Another one that I have on is where is it? My EuroCat. I went short again EuroCat at 136.90. As I thought, the oils might find a little bit of a bottom. It's done quite okay. I've already managed some of it around this 136.5 and then 136.25 this morning. I'll trade range there as well from the short side for as long as we cap below 137.60. Look at this 137.60, 1, 2, 3, one shoot through, but then again failing. And then yesterday we failed at 137. 137 figure 60 for me is a very interesting zone. If it caps, I'm going to try to defend a small core short and looking for a return to mid-range around 135.5.
Have you got your Italian-German spread?
Yeah, I've got it on. Oh no, I've actually, where is it? Let me put it on again. Must have made a mistake. There we go. Okay, there we go. We're right on the support there, and as we've seen, actually, it's quite interesting. Well, that explains a part of the euro dollar rally of the morning. I didn't have it up. I missed this one, but yeah, we are here around the support zone, give and take a couple of BPs. That's what Gentione and the other ones were talking about. It should be somewhere more around the 1.5% than above 2%. Then we are trying to get below, but it looks like stabilizing now, same as the euro dollar. Yeah, so this is one that we also should keep an eye on because it does drive the euro as well.
Yeah, just to refresh people who may not have been watching last week or new to the show, this is something that's come into focus now because ECB members, when talking about their fragmentation tool, which is largely going to be designed to stop yield spreads blowing out between the stronger countries and the weaker countries, north and south and what we call the periphery. They see signs of instability if the yields blow out. If there's big differences between German bonds and Italian bonds, or German and Greece, German and Spain, France and Italy, that sort of thing. And it's become a bit of a subject because some ECB members have put numbers on this. They say, like for Italian-German spreads, if they blow out to 200 pips, 250 pips, which in percentage terms, as Kay shows on that chart, will be 2.5%, that sort of thing. It becomes a bit of a pain threshold where the ECB may be forced to act. So this is something I mentioned last week. We just need to keep an eye on it. It's readily available, as you can see there on TradingView, just as a bit of background noise, if you like, just to see if spreads are moving. That could be a cause for why Euro's moving. As we said, it's correlations, seeing what wind is blowing which way at any one time. Well, this is potentially one that's a big win for the euro dollar at the moment, or the euro. So just keep an eye on that. If we get moves above 2% mark, use that as your sort of base level. Anything above 2%, then the market might infer that things are getting a bit risky, thus meaning the ECB might have to step in. That might put pressure on the euro. Conversely, as Kay mentioned, if we're down below 2% or the 200 pip mark, you know, moving down 180s, 170s, that may be bring a bit of support for the euro, see it heading higher because there isn't so much risk, if you like, viewed by the market. So again, it's just one of these things. Could be what becomes a short-term driver. A month's time after we've heard about the fragmentation tool, it may not mean a thing. But it's just one of those things at the moment. It's fresh in the market's mind as a driver for the euro, and if that's the case, we need to keep half an eye on it. Kay, you got anything else you want to share before I nick the charts back?
Not really right now. No, not really. I think, yeah, euro's coming back down a little bit. The stuff is really in ranges, in my opinion, right now. So yeah, I give it back to you.
Yeah, no worries, mate. Just while we're doing that, you know, Kay mentioned a thing about high yielders and low yielders. Again, for those that may not understand things like that, is when you get countries or central banks that are raising strongly, and we get these different rate levels in different countries, that can create flows, because there are traders who will park their money in where it can earn the most money, just from sitting in a currency. You know, it's apart from the currency risk, it can be, you know, fairly low risk because you're just pretty much playing on the interest rate. But also in terms of us as retail traders, that can be important. The rate differentials can be important because it affects our carry costs. If you're sitting in you know, short euro trades or long euro trades rather, it impacts how long you can hold stuff for, because it's costing you money to hold those trades. So if you're trading something that's got a big yield differential, like between the euro and the dollar, you know, being long certain pairs in the euro has an impact. It's going to cost you potentially a lot of money, versus those that have low FX impact or low rate impact. You know, for example, I'm in a short dollar Hong Kong position, playing the top of the band, just sitting in it. It's got zero carry costs. It's costed me nothing to sit in the trade. I'm trading this against the band. For those that don't know, there's a band between 7.75 and 7.85 that the Hong Kong Monetary Authority keep in place. We're bang on the top of that band. So I'm short up here. It's not costing me anything from those carry costs. And so I'm happy to sit in a trade and with a potential backstop of the Monetary Authority there. But you look at something like me being long euro sterling, it's something I look at every so often at the swap, how much it's costing me to sit in that trade. At the moment, it's not becoming restrictive to staying in the trade. I'm well up more than it's costing me, but those costs are creeping higher now. As if the ECB is hiking slower than the Fed, those costs are going to grow. So it is something you need to bear in mind as a retail trader. If you're sitting in positions for any length of time, just note your costs, and just to see if they become restrictive or not. But anyway, so just back to looking at the chart, and dollar yuan is one I want to look at here again. I'm still long a small bit myself, playing off this support area. We keep coming down close to it. The thing I'm mainly concerned about now is that the bounces are looking a bit weaker. So the price action is looking a bit against my view at the moment. It could mean that we're potentially going to get a proper test of that 660 or 666 area. Certainly, if we start to move below these prior lows, I'm going to be a bit more cautious. I have got some a bid in down at 6.65, but I may look to revise that down or pull it at all and just manage the trade if we do get a move, because the more times we come down and test this area, the more wary I'm going to be on the chances that we're going to get a break. And if that's the case, I potentially don't want to be long into that. Just playing this area here. So anywhere under this 666 level, I'm potentially wrong, and I'll either tighten my stops out and get out, or look to see maybe to carry it on and look at the next levels, which I don't really have much below that I would, have any great conviction over. Below here, we're definitely looking a bit dodgy again. So yeah, just playing the range here. Another one to look at. If we do get a push back up, I'm going to be looking at the high point again. The way things are in China, it doesn't look like the PBOC in a rush to ease. That's something we've obviously been a theme with the potential slowdown over there. They're doing a little bit of tinkering around with monetary policy, but nothing too heavy hitting. Conversely, the talk with Biden on potentially easing some sanctions, mainly to sort the US out rather than helping out China or more smoothing relations, is also keeping this off. This pair can be a good risk proxy as well, particularly for the globe, because currencies like Aussie dollar can play off of this one and what Chinese stock markets are doing as well. Quick look at that. Some of that, the Aussie dollar again. Nothing that I'm really interested in right now. We seem to be just going through the motions, as Brand mentioned earlier, a bit of oscillation, pinging up and down between the levels. So again, if we want to make a move higher, we've got to get back above the 70 handle as a first step. Then we got some smaller levels, 70, 30, 70, 60, 70, getting up to the 71s. These are all old levels that we've been up and down, up and down, up and down over the last few months, which is indicative. Take this out to a bit of a longer view. It's indicative of a bit of consolidation. Come out to a weekly chart, and you would say that the trend is still perhaps lower. But where are the key points? The key points in the short term around about 69, and then these series of lows, down to the mid 68s, low 68s. That's going to be your crunch area. If this trend is to continue, that's the sort of area you want to see breaking. And if it does, then potentially that's what you want to look at going with a break trade. So that's pretty much it for me. Just a quick look at the S&P, because as I say, we have got this risk move going on. If we do see a move up, look towards this 31.10 area, 10.11. We'll probably see resistance coming in and the big figure 38. Just to repeat once again, and I apologize if a lot of stuff we're saying is repeats of the same mantra, but if we get up to that area and can't break it, that suggests we haven't got a real change in the mood today. And that's what the levels we look to trade. If we get these solid levels, can't break it, then you got a bit more conviction to try a short again, see if we get to move back down to the lows. So yeah, as I say, I wish you luck for today. Hope you make many pips, and hope you enjoyed the show, and we shall see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.